macro market trends, stock selection, ETFs, options. Just some of the topics covered in Cook's Kitchen.
Welcome back to Cook's Kitchen. Today we're going to answer the question, what's eating Goldman Sachs? We're going to talk about valuations in the market. Let's first look at some charts. I want to talk market breadth, and we're not going to use any fancy oscillators. We're going to just look at a few indexes that very simply tell us about market breadth. Number one is the S&P equal weight. Looking very healthy here in this rally, made new highs. That's what we want to see, so just not the mega caps are carrying this. But we are, yesterday, close above 3,200 new highs on the S&P equal weight, was over 3.4% above the 50-day moving average, getting a little stretched here. Next, let's go to the NYSE, my other favorite index to talk about market breadth, primarily because it has so many mid caps and small caps in it. It's also got some Chinese ADRs, and it was our marker for the correction that began in late September as it broke down hard. All right, so what do we see here? Not making new highs. We still have this double top on the NYSE at 11,100. It's struggling here. Look at the declining volume. This is a pattern. We're going to talk about volume again, but the market is just, it's trying to inch higher, and the volume's just not there. To me, this is part of the chase, right? Bears that, maybe still tried to put on some shorts, and the bulls who are still chasing it, look, they waited for a pullback. They didn't buy under S&P 1900. They didn't buy enough under S&P 2000, and they're waiting for a pullback, and they're not getting it, and they have to have long exposure here into the fourth quarter, so that's the bull chase that's on, and we nibble higher. Next, let's look at, oh, by the way, one more thing about the NYSE. Hey, 50 and 200-day moving averages getting ready to kiss. People will be talking about a death cross there soon. All right, let's look at the NASDAQ. Triple Qs, I like to look at the tracking ETF. Triple Qs have been strong because this is the NASDAQ 100. Your mega caps, Apple, Google, Priceline, Tesla. So these big stocks have been under accumulation. Why? Because technology is still hot and fund managers need a little bit of safety with their growth appetite. So that's why the Triple Qs have led so much here. But I don't like this price action at all here. I mean, this is sort of bull flagging, waiting to go higher, but all these candles here are ugly, dojis and all sorts of other things. This could roll over, and look at the declining volume here too. So this is just the Triple Q. So you're getting a real look at volume, versus what happened in October. And, so this thing could, I said yesterday, look for a sort of a blow-off short-term top up to 103 in the Triple Qs and then pull back. And that still could develop this week because, tons of gaps to fill. And I don't think we're definitely not going back down here. Could we go back down to 99 and fill that gap? Maybe. I think there'll be buyers before that. So we'll be lucky if we fill the gap from, late October, the Halloween gap, as it were. All right. We're going to talk about Goldman in a second. First, a couple other things I want to mention. What led this rally? So it wasn't just big cap tech, it was also industrials. In the past month, if we just look at the main S&P sectors, industrials put on over 12% just in the past 30 days. And, other leading indexes, barely touch that. Technology 7 to 8% for technology, utilities, healthcare, and what else? Financials even. So those four areas: financials, utilities, healthcare. They tacked on 7 to 8%, but the industrials put up 12%. So that's encouraging. We've had lots of strong data. So why wouldn't fund managers be taking off short bets and putting on long bets on a strengthening U.S. economy? Because all the data says, hey, 3.5% growth into next year. All right, let's look at a difference of opinion and this sort of valuation call from Goldman Sachs. Let's go to the chart first. So what we have here, this came out in late October from Goldman Sachs, and the key headline was that they lowered their earnings estimates for 2015 to $122. That's below consensus. Consensus is around, let's say, 127, 128. I'm sort of more at 125, but Goldman lowers this. Then look at the associated price targets. Okay, year-end price target 2050 for the S&P. We're already there, and we'll talk about what market multiple that is. The other headline numbers were they're looking at S&P 2100 by the end of 2015 and 2200 by the end of 2016. Now, if that doesn't strike you as being almost bearish, let me help you out here. So at 2015, or at 2050 on the S&P, and the S&P could earn $116 this year, that's a multiple of like 17.7 times. Okay, sort of rich, and that's this year. Well, if you go out to 2015 and you say, okay, the S&P aggregate earnings are going to be $125, what multiple do you put on that? Well, my target for the S&P 500 in early to mid 2015 is S&P 2250. And I get to that math saying that the market will pay 18 times for $125. 18 times $125 gets you to 2250. But if we go back to Goldman's outlook here, what they're saying is, hey, the S&P only earns 122, and they don't think that the S&P will reach 2100 by the end, until the end of 2015. All right, so let's crunch the math here a little bit more. All right, so that $122, their estimate, is still 5.2% earnings growth from the S&P earning 116 this year, if it makes 116, which it probably will. All right, so what does that price target tell you for the end of 2015? 2100 is 17.2 times. So some people think that that is expensive. I don't, because in a strong bull market, the PE will continue to expand, especially with low interest rates, especially with central banks, backstopping economies. Not necessarily in Japan, they just buy the market. Our Fed doesn't do that, but that rates are going to stay low for a while because we have a labor economist heading up the Fed, and she's going to make sure that jobs growth is there before she pulls the plug. All right, so again, how cautious is Goldman Sachs? I think they're very cautious, because even though we're talking about record earnings growth into 2016, $131, that's 7.4% earnings growth from 122. What multiple is that? That's again around 17 times, but they're not looking for S&P 2200 until 2016. So to me, they're very cautious. Not only did they bring 2015 estimates down, but I think that was the first shot, and that they're holding back, and maybe they're not getting ready to make a recession call, but maybe that's coming down the road. Maybe they're looking at a lot more data in terms of earnings in the economy, and just really holding back on where they see estimates going and what they think the market will pay. Now, this is not their preference of what they think the market multiple should be. In a true trading and investing top-down macro call, you guesstimate what you think the market will pay. And if they're saying that the market will only pay 17 times for this record earnings growth of maybe $125, $130, then they're being cautious now for a reason. What is that reason? Not sure yet. Let's look at one more chart. Speaking of, so we covered the Goldman Sachs valuation call. I just want to show you one more thing before we go here. This is a study done by Dana Lyons of J. Lyons Fund Management, looking at the S&P making 3 straight weekly 52-week highs. So, the spiders in this case have 3 weeks in a row made new 52-week highs. How often has this happened in the past? Well, he went back to. It looks like we might have a mismatch here. I thought this study went back to 1996, showing 7 occurrences, but actually it looks like he only went back to 2006. still somewhat relevant for what I'm trying to talk about, where the market has really run ahead of itself here as the bulls chase. So the bottom line is that, could the market keep going higher? Of course it could, and make another new 52-week high on a weekly basis. But it's getting overextended. All right, I think I covered just about everything. Main point being, go back, look at the video, pause the video so you can stare at that Goldman Sachs chart of their EPS estimates and their targets for the index itself, and do the math. What kind of valuation call is that? They think that the market will still pay 17 times for those earnings, but it's not typical of what you see in a strong bull market, where you look at it, they've got earnings projections out to 2017 that are still making new records, and they don't have the multiple expansion there that you would expect, because what tends to happen, the reason my call is for 2250 in the middle of next year, is because what tends to happen in an expanding economy and bull market is that you pay for the following year's earnings. So the market really starts paying for 2015 earnings and assigns a higher multiple, and Goldman Sachs just doesn't see it that way. All right, thanks for joining me in the kitchen, and I'll be back next week. We'll take a look at a few more exciting things.